Hello everyone, welcome to week 6 lecture videos once again. And this is learning objective 3. Well, there is a large volume of evidence documenting that historically momentum strategies have outperformed the market that we have discussed in the last slide. Last learning videos. But what now we want to have a reason why that momentum strategy actually works. So in these learning objectives, we examine the explanations for momentum such that we can identify the particular investment philosophies and particular building blocks of markets that momentum aligns with. There are three main explanations for momentum. One school of thought is that returns generated by momentum portfolio is capturing risk that's not explained by traditional models like CAPM. However, the majority of arguments in the academic research suggests that momentum is a behavioral phenomenon. This particular argument suggests that investment in momentum can be explained either by underreaction to information or potentially a combination of both underreaction to information and subsequent overreaction to price performance. So we will look at each of these explanations, and first of all, we look at risk-based explanation. The idea of risk is that we know that investment strategies or assets that have higher risk should be rewarded with higher expected returns. Now, the traditional measure of risk, such as standard deviation or the model like CAPM, is not only the only source of expected returns. Perhaps there are additional sources of returns. Therefore, researchers have looked at whether the momentum strategy is related to other sources of risk, such as macroeconomic risk, and potentially where the winners are simply riskier than losers, therefore explaining a higher expected return. This argument was first put forward by Conrad and Cowell in 1998. However, there has been a large body of evidence that shows that the momentum strategy does not appear to be explained by exposure to risk. Hence, this particular explanation is largely been refuted. However, one potential alternative risk-based explanation might be if we look at risk in a non-conventional, non-traditional sense. The majority of research that has suggested that momentum can't be explained by risk look at a table, a sort of table like this we see on the screen, and with a particular focus on the top two rows, I mean mean and standard deviation. So what we can see here, these are the returns on the portfolios that is formed based on past performance over the last 12 months. We hold the portfolio on subsequent 12 months and rebalance annually. So we end up with 10 portfolios from extreme losers based on the past performance to extreme winners in the first row. And we can see that past winners completely outperform the past losers, and it's a dramatic. You can see 1.52 and losers generate only a mean return of 0.34, and you can see that there is a monotonic increase in returns they generate as we move from loser to winner portfolios. So a risk-based explanation would argue that winners would be riskier than losers. However, as we look at the second row, that's the standard deviation of the portfolios, what we actually see in terms of risk or standard deviation, we can see that winners are actually appearing to be less riskier. You can see the standard deviation of winner is lesser than that of losers. So winner portfolios are basically less risky as we measure risk in terms of a standard deviation. So this is one amongst other arguments that speak that why momentum can't be explained by risk. However, what if we think risk in a different context? What if we think about downside risk or think about investors that have different preferences such as those of a prospect theory? We might want to consider here at the skewness of this particular investment strategy. Look at the third row here. Where we have documented the skewness of the portfolios from the losers to winner. What we can see is despite earning an average lower returns, the return on the loser portfolios tend to be highly positively skewed. You can see the skewness is 1.8, whereas returns on winners tend to be negatively skewed. You can see as we move from losers to winners, the skewness decreases and then it becomes negative. Now, if investors do have lottery preference, that is, if they do have preference for positive skewness, they will be willing to accept a lower return on that positive skewness. So one potential explanation for momentum here is that downside risk of winner portfolios, which might explain those high returns of the winners. So another way to think about this is to look at the time series of momentum returns across a time period. So what we have got here is cumulative returns to the momentum strategy in the Asian region from 1990 through to 2012. So what we have doing here is we got a zero investment portfolio where we take a long position in the past winners and a short position in the past losers and look at the cumulative returns starting from 1990 through to 2012. We can see that the trend is significantly upward if you can look at the general trend. That is, momentum strategy was quite an effective investment strategy that generated a quite significant positive abnormal return across this time period. But one interesting point to note is that there are two distinct periods across the time series where momentum strategy has quite significant drawdowns. You can see these two periods. So this, what this brings, that negative skewness. These two periods correspond to this is the Asian crisis and this is the global financial crisis. Just you can see the rebound from the Asian crisis and the global financial crisis period. So what we see is following a market crash or period of high volatility, when the market subsequently reverses during these periods, momentum actually does poorly. And that brings about this downside risk to momentum strategies. So although traditional measure of risk such as standard deviation cannot explain momentum profit, one different non-traditional risk-based explanation, downside risk, may provide a plausible explanation for risk. However, the more widely accepted view with respect to the root cause of momentum return is that it is a phenomenon that's related to behavioral characteristics of investors. So this ends with the view that investors as a whole tend to underreact to information. So there is a whole lot of evidence in the psychology literature that shows that we as human beings underreact. We are very slow to update our belief system when new information comes to hand. So what this might result in that we might have a firm, for example, that announces a positive earning result. That's a good news, so the price should increase. But if you underreact, instead of the price increase immediately or jumping the price immediately to a new fundamental value, there might be a slow, gradual diffusion of that information into the prices as investors slowly update their beliefs in knowledge, and that results in a price continuation. So underreaction can result in this price drift or continuation of returns. Hence, it's been argued that it's potentially what explains momentum. So coupled with the idea of underreaction is the view that investors also tend to place too much emphasis on recent price performance. So investors underreact to information, to news, but actually tend to overreact to price. This is known as the representative heuristic. We have got this initial underreaction. Zone. News comes out, say a positive news, positive earnings announcement. So market is slow to react to this news. So there is a gradual price drift to fundamental value. But then if investors are overreacting to price change, what this means is once the price drifts to fundamental value, it actually keeps drifting upward in the positive direction, further away from that fundamental value because of the overreaction or the over extrapolation of that trend. This is argued by Barbara Schleifer and Vishnu and Hong and Stein as part of their momentum profit. Well, we might say that these arguments around underreaction or overreaction are merely just beliefs or arguments based on the characteristics we know about the psychology of investors. There is some evidence if we look at the performance of a momentum strategy that is associated with this belief system. So this is the research that was done by Jagadish and Titman in 21, where they said that we can actually identify the root cause of momentum returns by looking at what happens to the returns of a momentum strategy in the period after our initial holding period of investment. So we all know about momentum strategy is that at zero time period, which is at the start of this axis, which is here. We have ranked all stocks based on their past performance. Let's say that that's a period of last 12 months. Based on our ranking over the past 12 months, we then identify our portfolios of winners and losers, and we invest for a period of 12 months. Across our investment period, with a normal momentum strategy, we would then rebalance every 12 months, that is at the end of each year. We then re-rank our stocks and buy or sell stocks within our portfolio such that our winners now reflect those stocks that are winners over the past 12 months, and our losers are those stocks that were losers over the previous year. So what if instead of rebalancing annually, we just continue to hold the portfolio? Let's say we hold the portfolio for 5 years. It's important to look at different price patterns across the subsequent period. So if momentum is explained by risk, that would mean that winners are riskier than losers. So winners would have constantly a higher expected return than the losers. So we should say on average that winners would outperform losers over the investment period. But then, because they are still exposed to higher risk in the subsequent period, we should see a continuation of the outperformance of those past winners right through time. So if we hold the portfolio for 60 months, we should see that every one of those 60 months, on average, winners should outperform losers. So the curve should look like this. Now, if momentum should be explained by underreaction to information, what we should see is we should see the price drifting for a period of time. Let's say that period is investment period. Price drifting until it gets to fundamental value, that is until the information is fully incorporated in price. But then there should be no abnormal return. That is, there should not be difference in the returns of the winners and losers portfolios in the subsequent period. Because once the price gets to fundamental value, there should not be abnormal returns systematically achieved either by winners or losers. So this pattern here, you can see that the momentum phenomena first, but then subsequently no abnormal return, which is consistent with underreaction story. If there is a combination of underreaction and overreaction that we spoke about before, we see the price drift, price continuation, but because the subsequent overreaction pushes across further away fundamental value, we should eventually have arbitraged and return to fundamental value. So what we should actually see mean reversion, whereby you find that after the initial year in the subsequent period, if you hold that portfolio over a longer period of time, you would see winner actually underperforming losers, say from month 13 through the month of 60. So you can see that it's basically the mean reversion and the momentum portfolio basically underperform. So if we look at the actual pattern of returns of momentum strategies across time, we might be able to differentiate between these arguments. Jagadish and Titman show the evidence that appears to be pretty strongly correlated with the expected pattern that we see by the argument of underreaction coupled with overreaction. We say momentum phenomena, winners outperform losers for a period, you can see for a period up to a year for different momentum strategies. However, as we continue to hold the portfolio, we consistently see across all different periods, we can see the evidence of mean reversion. That is, the returns of winners actually underperform the losers from about 12 months onwards. So if we have not rebalanced annually, kept holding the same portfolio for 60 months, this price pattern of returns tend to suggest that momentum is explained by behavioral phenomena. So momentum is consistent with an investment philosophy where you believe that there is a less than perfectly efficient market and that market failing might be due to behavioral biases of investors. That's consistent with the psychology literature suggesting investors underreact to news and overreact to past performance.